Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today we're going to look at the SPY. That is an ETF that tracks the S&P 500 index. We're going to look at using that ETF to protect your portfolio going into the election. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, after a big down week last week in the S&P 500 index, we're seeing a little bit of a green on the chart. What do you see going into the election tomorrow as far as the markets are concerned?
Yeah, we definitely got some interesting action this morning after a week that was not pretty for many investors. The market declined 5.6%. That's the S&P 500 last week. Wednesday was the worst day that we've seen since June, where the S&P 500 declined 3.5%. It continued its decline through the rest of the week. But today we've got some green ahead of Election Day tomorrow. And that is really the biggest event that is on investors' minds right now is what is going to happen with the election. But I think there are a couple other things happening that are helping to boost the stock market this morning. One of which was some economic data that came in a lot better than expected. So we actually got the ISM manufacturing index this morning. It came in at 59.3, which was better than initially expected. And it's the highest level seen in 2 years, showing that the manufacturing economy is still recovering into the month of October. Also, new orders, which is a component of that economic data point, were higher and reached a level not seen in 17 years. That's as people start buying more cars and more durable goods. So that's going to be something to think about as we go into the latter part of this year and into the next year, because the biggest question I think for investors now is what does the reopening story look like? But looking at the chart of the S&P 500, I'll get into that in a minute, but looking at the chart of the S&P 500 here, Brian, you've got some red lines on this graph. The bottom line that you're highlighting now is about that 3,200 level, which I find interesting. I know you have some thoughts on that, but correction mode from the recent high on September 2nd would have been 3,220. As of right now, it looks like we're avoiding reaching a 10% drawback. That's what a correction is. 10% drawback between 10% and 19.9%, I guess you could say, in the stock market. And that 10% would be at 3,220. We're bouncing, like we said, today. So that's good from a technical perspective. When we think about the election, we want to get past Tuesday. We really want to get past Tuesday because that has just been a big fat uncertainty for investors. And so I think that investors just want to know who is going to be our next president, what type of policies are they going to put in place, how is that going to impact economic activity, and how is that going to impact corporate profitability, right? So guess what? We're going to be past that on Tuesday. Hopefully, though, there is that concern by investors that the election might be delayed or results might be delayed, or there might be a contesting of results by the losing candidate. We don't know for sure. So I think even though we're up today, there does remain some nervousness with investors. There's also the concern about what's going to happen with Congress. What's the makeup of Congress going to look like after this election? There are some Senate seats that are up for grabs. And if the question is, does the Senate become blue, and does Congress, is it going to be run by the Democrats? And that'll have policy implications going forward. So that's another question on investors' minds. But like Brian, you and I always talk about, you should be investing for a 4-year presidential cycle. You should be investing for the long term. If you look at a really long-term chart of the S&P 500, it's gone up and to the right. That is the major trend line at least. Of course, there's pullbacks, there's corrections, there's bear markets also along that way. But on average, since 1950, we've seen the S&P 500 advance 8% a year on average. So that's a very positive sign that we're thinking about as we go into next year. This pullback before election day, historically, it's meant that perhaps we get a new president and the incumbent has to give up the reins. But every election year is a little bit different. We do know, Brian, though, that volatility has spiked going into the election. And but today it's down slightly while the market's up. It was up this morning, though, if we look at the VIX. And the interesting thing about elections is, though, we've been talking about the volatility for the last couple months, I feel like, Brian. But what you usually do see after the volatility runs up going into the election, that after election, volatility has historically fallen off very sharply. But you've been keeping an eye on these futures contracts in November, December, even January. What's it telling you now? Do you expect that drop off to once again occur at the end after we get past this election?
Well, yeah. Well, I'll tell you what the futures are telling us overall. Yeah, I do have my VIX watch list up in the LI Invest dashboard. And we see here a couple of things first of all, I added our February futures contract. That's still trading close to that 30 level. And I guess that's probably the bigger surprise. You talked about volatility is usually dropping off after the big news event, which in this case would be the election. But we're seeing that even out in December, in January of next year, even February, the VIX still staying elevated relative to where it was before the pandemic and at the beginning of the year. We see today the VIX is at around 37. It is down a little bit, but we got a pretty big up day. So the VIX is basically, I would call it flat relative, considering that the S&P 500 index is up 41 points right now. And one thing that I wanted to highlight that I think really highlights the nervousness of the marketplace going forward is the VVIX. Now, I don't talk about the VVIX that often here on the stock play of the day. It's what it is a VIX of the VIX. In other words, it's highlighting the implied volatility of the options in the VIX trading index. So if I think of this, I'm looking at what is the volatility of the volatility index. And that's spiked recently. That's up to 140. And I highlight this on our dashboard with this little chart. And I'll slide over here to my right. And we'll see here that obviously this is going to be a big number. Like the high when the pandemic was, or the lows of the pandemic in March, we saw the VVIX up as high as 210, 209. And recently, we just saw another big spike up. We see the VVIX index up. Today, it's trading at 140. We saw it spike up as high as 150. So just interesting to see these option contracts spike in volatility. And a lot of that, when we talked last week about the VIX index and the fact that it ran up to 38% implied volatility. And in my mind, that means there's a lot of people that are using the S&P 500 index as a hedge, as a institutional hedge to manage portfolios against the downside. And we're going to talk about that today and how we might want to do that inside our portfolios if we're considering it. If we're as nervous as what the VIX is telling us, then that is driving up not only the S&P 500 index options, but we're actually driving up the prices in the VIX index or the volatility, or buying call options in general in the VIX index, because it's an inverse relationship to the S&P 500 index, is driving up the VVIX, which tracks the volatility of those options inside that underlying. So with that said, I think I'm just going to jump right into using index options as a protective.
Let me, before you do that, let me just jump in, Brian, because I wanted to make a point. It's interesting, the action that you're seeing in the volatility. And by the way, it's not just the election that we have this week. I'd remind investors, we have about 118 companies reporting earnings this week. So it's the second busiest week for earnings this quarter. They'll be reporting third quarter earnings. We've got about 66% of companies already reported. Earnings have been really good. 81% of companies have beat. We also are going to hear the Fed speak on the 4th and the 5th of this week, too. So we'll hear from Fed Chairman Powell. And then also on Friday, we end the week with a jobs report. So there's a lot of information that investors are going to be digesting through the course of the week that maybe will make them feel a little better about whatever the election outcome is. So that's a bunch of stuff that we've got on our mind. And also, interestingly, too, not only have earnings been good, you're saying this spike in the VVIX maybe is indicating that volatility could come down after the election. We've seen that happen historically in the past. We've also seen bond yields rising in the last couple weeks, where I think at point we're at 85 basis points or 86 basis points, I think most recently, and some commodities are still hanging in there too. Copper's up, so you're getting a mixed signals from different parts of the market for sure, Brian. Which is why I think what you're going to cover today, Brian's going to cover a couple different type of strategies that you can think about deploying to protect your portfolio using options ahead of the election. So you're going to stick around for sure, because he's got a couple different options for you to think about. But I want to remind investors too. I see a couple of you guys chatting us in the chat box over on the right in YouTube. We'll be taking questions at the end. I'm sure you're going to have a lot today too. So with that, Brian, take it away.
Yes, that boiling pot is becoming very full in the witch's brew, I guess, if you could say, to make the Halloween analogy. But overall, yeah, there are a lot of things above and beyond just the election. You have a tendency, us as analysts will have a tendency to focus on that, but there's still a lot of things going on in the world besides just this one-off election date. And like you mentioned, you said maybe after earnings we'll see implied volatilities go down. So I'm just going to make one comment on that, in that the futures aren't really indicating that, except for the fact that the spot or the actual VIX index is up around 37 and the futures are lower, down around 30. But we did, by looking at some of the trades, some of the big trades that are actually happening in the VIX index, which is driving up that VVIX, we're seeing a lot of put paper. In other words, we're seeing a lot of trades, big trades coming in on the put side of things, guessing that the futures contracts have it wrong and that they're looking for a bigger downturn than what the futures are implying going into the new year. So thanks for bringing that up, Lindsey. That was something that I did want to address. Now let's get into using options to protect your portfolio. Now, nothing's meant to be a recommendation here on the stock play of the day. We just are following the fact that we're seeing the VIX index up so high. And that means that, to me, overall, that the marketplace is nervous. So I came up with 4 different ways of looking at this, okay? So we're going into the election tomorrow. So a lot of people, and I have talked to a few swing traders in particular, people that are using technical analysis, but there's so much news out there right now. They're a little bit scared to use their way of trading. And they're just basically saying, I'm out. There's too much going on in the marketplace right now. And I'm just going to go out until the end of this week and then maybe think about getting back in after this news cycle plays out. The next way to look at it is, I'm out, but I'm nervous about a rally after the election. How can I use options to protect myself against a rally? And by saying I'm out, I've sold everything. I'm out of all my positions, and I am just looking at, after the election, what might happen. And then next in my notes here, I have, well, I own all my portfolios. Maybe I've sold a few stocks or whatever, but I'm still nervous about the downside. So how can I protect myself on that? And then lastly, obviously, we won't really address this one, but I'm just going to ride the wave. I'm going to just ride it. I'm going to keep doing what I'm doing. I'm going to keep with my investment strategy. I'm more of a long-term investor overall. So those are 4 different aspects that we can talk about. Now, how can we use option contracts to try to protect ourselves on all of the first 3 that we were looking at? So the first one is, I'm just out. I'm not going to do too much risk. I'm not going to trade. So I'm going to just sell my portfolio and remain cash, or at least parts of it. Now, if I want to protect myself, I've sold. How can I protect myself against an upside rally? Well, I have index options here, and we're going to look at 2 different ways to address this. And it's really about how much you're willing to spend and the size of your portfolio. So we talked about it at the beginning of the show that we're going to look at the SPY. Well, the SPY is derived from the SPX index. So if you want to learn more about index options, I'm highlighting it inside the options playbook because index options are a little bit different. So if I wanted to speculate, I'm a little nervous. I just sold my portfolio, but I'm nervous about the upside. What are two ways that I can approach this and protect myself against an upward movement in the marketplace without spending a ton of cash? I'm going to have to spend some cash, and I'm going to base this off of a $100,000 portfolio. Okay, so if I have a $100,000 portfolio stocks, I just sold it, nice round number. What could I do? Well, one of the things we could look at doing is just buying a long call option. So where do we want to buy that long call? Well, we could look at the SPY or we could look at the SPX. How many calls would I want to buy? If I want to protect myself against an upside movement in the marketplace, how might I do that since I now do not have a portfolio of stocks because I've already sold those off? And one way to look at it is a long call option. And so let me run over to the Ally Invest option chains here. One second. Oops, I'm going to have to pull it up right here. And if we're looking at the S&P 500 index and the SPY overall, the SPY, before we started our little chat today, the S&P 500 index, I'm just going to kind of round that off, was trading at 3,310. That's a nice round number there. And we had the SPY at 330. Okay, so if I'm looking at this on a portfolio basis, and this is not an exact science by any means, you have to first of all pick the index or the ETF that you think tracks the portfolio that you had previously. And with the SPY at 330, you literally just take the value of the SPY and you multiply that by 100. So if you take 330 times 100, that's $33,000 worth of a portfolio value. So I want to get through the election. I had a $100,000 portfolio. How might I use the SPY to protect myself against an upward movement in the marketplace? Well, like I said, it's not an exact science, but if I have $33,000 each option contract represents, then the total amount that I want to buy is 3 call options. If I want to try to protect myself as much as I can against an upward movement in the marketplace. So we got the SPY trading at 330. It's still staying right about here. How far out do I want to go? Do I just want to get through the election? Well, if that's the case, well, then I can actually just go on out to the end of this week and I can look at the November 6th call options, which are, I think that's 4 days away, exactly where we're going to end up at. That's Friday. Yep. There's a lot of different expirations to choose from, but we're going to go to that November 6th expiration date. And then just look at buying a little bit out of the money option contracts. So how can I protect myself? The market's right at 330 right now. I have to ask, well, what am I willing to spend? What am I willing to put up as risk to protect myself against a rally in the marketplace? And the answer on here, I'm just going to go with the 333 strike call option. And I would just click a little buy right here, scroll down to the Ally Invest options workbench. And I'd say I want to buy 3 contracts to protect myself against an upward movement in the marketplace. And I just sold a $100,000 portfolio of stocks, if that makes sense. So this is one way to approach it. Now realize it's not going to be exactly like owning that stock portfolio. You do not own that stock, but if you think about protection and what it truly is, do you usually say if you crash your car, do you get the full value of the car back, or do you get some depreciation minus the deductible, right? That doesn't usually behoove you to crash your car, right, overall. So this is just a way to look at it as I'm going to give myself a little bit of protection because I was nervous about the market and I got out. So I'm going to put this in the right rail, and I'll call this the official paper trade, right? And I just think this is an interesting way to watch. If you want to learn about how options were first intended to be used, and that's what they were intended for, to be used as protection, both call options and put options. That's where they came from. So right here, the midpoint is at 108. If we were trying to protect a $100,000 portfolio, we look at buying approximately 3 call options. And at that limit price of $5, that would be about $1,500 that I'm going to put in as my protection against against a movement to the upside if after the election the market takes off. Okay, now let's look at the SPX. I'm going to change this up. Now, if you were thinking that you had mainly NASDAQ stocks, you'd be looking at the QQQs. The QQQs is the ETF that basically tracks the NASDAQ. And that was trading at 270 before we got on our YouTube video today. And so that means one option contract would represent about $27,000 worth of stock overall. On the downside, let's look at the SPX. So the SPX is obviously a much larger valued index, right, than the QQQ or the SPY as far as a total valuation. So how would I think about this? What if I own some stocks that kind of track the S&P 500 index? How might I protect them against the downside? Well, if I'm in that position, this would be number 3 on our list. I'm in but nervous. I could look at buying a few put options. Now, they're going to be a little bit pricey in this day and age, because of the volatility and what we were talking about on today's show. But if I want to buy some put options in the SPX, it's up $40 today, about 1.2%. It's a 3,000, we'll round it off, 3,300 point index. When I looked at it before we started, it was $3,310. Multiply that by 100. That means one put option would represent about $331,000 worth of market value. So that's quite a bit. That's why I'm talking about ETFs and I'm looking at the SPX. Now, there's a little bit different nuances in the index options, and that's why I also highlighted that inside the options playbook. But next question would be, if I'm going to be trading these option contracts and I just want to get through the election, how much am I willing to put up, and what would be my deductible as far as my insurance is concerned? So we got the SPX at 3,308, right? Well, right around 3,310. Would I say, okay, today was a 40-point move to the upside. That's about 1%. Am I willing to take that as my deductible to the downside? Would I move down about that 40 points? Or am I willing to take a little bit more risk and I'll go further out of the money to pay a little bit less premium? So on the downside here on the SPX, I'm going to give ourselves a few, think about what on a percentage basis, where do you want your insurance to kick in? And let me grab this here. So with the market trading at 3,307 right now, let's go down to the level that Lindsey and I were actually kind of highlighting on the chart, the 3,200 level. So in this instance, if I wanted to protect my portfolio of stocks, and now it's very important to highlight here that this is not an exact science. You need to have an index that kind of tracks your portfolio to do that. You're saying I will take the risk from 3,310 down to 3,200, and I buy one put option overall that can protect my portfolio of stocks against a downward movement in the marketplace. So for every put option that I'm buying, I'm going to highlight the ask here because it's simple, $3,100. All you do is take 100 times 31, and that's going to cost you $3,100 to protect yourself until Friday on that portfolio. Now, realize you have a deductible, but you're talking about a catastrophic move to the downside, and this is what this is trying to protect you against. Not an exact science, but a simple way to look at options as a portfolio against a downward movement in the marketplace. Okay, now, I also want to highlight a couple other things. If you just have a one-off stock, a strategy that you can look at inside the options playbook is a protective put. Let's say I just own Apple. Everybody in the world seems to own Apple at some point in time in their life if they're an investor. How can I protect that one position? If I own 100 shares of Apple, I can buy a protective put just on that underlying stock. If I sold the stock, what's the alternative? I can buy the long call. And I'm going to highlight here. Notice that a protective put basically has the same profit and loss graph as a long call. Why? because they're synthetically the same. They're going to limit your downside risk and still give you unlimited upside. Now, options are expensive. What's another thing I could do on the underlying stock? I could actually collar that position. In other words, I can buy a protected put and I can sell a call against that position on the upside. That's going to lower the overall cost, but it's going to do it at an opportunity risk. If I sell that call and the market does rally on that one particular underlying stock, I'm limiting my upside potential by selling that call, but I'm using that revenue to help pay for the put options. So this, in general, is a quick synopsis of how you can use options, not only on a portfolio of stocks as protection, but also on an individual stock if there's just one that you are nervous, a little bit more nervous about than the others. And i.e., we've had that with the pandemic. Lindsey and I have talked about a lot of stocks that have benefited from the pandemic and a lot of stocks that haven't benefited. Well, if we had a huge run up going into this, is this make you a little bit more nervous that we're going to have this big event? And what might happen after this event to the stocks that have gotten a little frothy? All right. All right, Lindsey, I see the questions piling up over here in the chat box. Please feel free to answer your questions. We're going to try to address it. We're a little bit long. I'm a little bit long-winded today here on our show, but we had a lot of topics to cover here before this big event tomorrow. So, Lindsey, do you have one in particular you'd like to address or start off with?
Yeah, there's a bunch of questions. That was great. A lot of different scenarios for our viewers to think about as they approach tomorrow. But Amit asks, why not buy an iron butterfly at ATM on SPY? That way you can be safer in the market moves either way.
Buy an iron butterfly at the money is what ATM would stand for. Buy an iron butterfly. If I was doing, well, there's a couple of things in there that's a little tough. Iron butterflies, if I'm doing it as an iron butterfly, it usually means I'm bringing in a net credit to the account. If you're doing that trade, you want the market to stay where it's at. And to me, and I can pull it up inside the options playbook here if we want to highlight it. An iron butterfly is saying we're going to have less volatility than more. So I don't know if that strategy really applies here. We're just more looking at nervousness. And, you think about this. Let me highlight something that relative to that statement. If I'm buying this insurance, I don't usually buy insurance because I want to crash my car, right? I'm buying it in case I do. I'm hoping that insurance expires worthless, honestly, and that the market outperforms and gives me some valuation to the upside. Because if I buy a protected put on my portfolio in an index, my best case scenario is that the market goes up 10% as opposed to down 10%, right? Because I'm going to be better off on the upside. I just want to emphasize that. But I'll highlight let me get to that iron butterfly, and then let's go to a couple more questions. Here is the iron condor, iron butterfly. Okay, so right here inside the options playbook, this is the strategy that was in the question. You can look it up if you'd like to learn a little bit more about it. But I don't think it applies in general to this case because we're looking to, this show is all about hedging your portfolio as opposed to speculating on if volatility is going to come in after the election.
Okay, that was a good explanation, Brian.
Too long though. I'm sorry. Let's get to another question.
But it's thorough. It's thorough. Wayne asks, hi, Wayne. You're here every week. I love it. If I look at the implied volatility on the SPY December and January options contract, will it show me if there is contango or backwardation?
Yeah, it does, but you get that. Oh shoot, I lost my dashboard. It shows this right on the dashboard. When we look at the futures contracts, it kicked me out. If you look at the futures contracts, it shows you that as we go into the election and beyond into the new year, that implied volatility is expected to go down based off of the VIX being at 38 now, and the VIX out in the December contract, I think, was trading right around 29 or 30. So we are expecting the implied volatility to go down. But even with that said, they're still high. They're still inflated after this big event. And I think that's more of the news story than anything, that, yeah, they're expected to go down, but they're not expected to go down below 30.
Yeah. So Brian, one more question, well, two more. Robert asks, with the validity in the market because of the U.S. election, what are your thoughts about staying on the sidelines until the election and results are finalized? And I think, Brian, you talked about that a little bit. It's definitely an option you can have. And we've seen a lot of our customers at Ally Invest take a little bit of a breather. A lot of professional investors are kind of in wait and see mode until we get through tomorrow night. So I don't know if you have any quick thoughts there.
No, I think you summed it up well. And I mean, that was basically profile number one, right? Just get out of the marketplace. So how can I protect myself against the upside? Buying out of the money calls. So that was one of the scenarios we went through. You can just sit on the sideline. It's too risky for me. I'm out. Or an alternative is to spend a few dollars, not a ton of dollars, saying that, oh, I'll protect myself if the market rallies after this election. And how can I do that? I buy some index call options or SPY ETF call option.
And then I don't know this off the top of my head, actually. Does Ally platform support trading in the minis? Example X.
No, we don't. We do have a futures platform, but you're talking about the E-minis, and no, we don't have that ability through Ally Invest. We have an outside vendor that does some futures trading, but not the E-min.
All right. Well, thanks for that, Brian. Well, that's going to wrap it up for our show today. What a great way to think about the crazy week that we have ahead of us. Be sure to tune in on Friday. Brian does his stock play of the day overtime show, where he'll review all of these strategies and see how things have played out on Friday at noon, same place, same time, just on Friday. So be sure to check that out.
Yeah, so in order to get the alerts, please make sure you click subscribe and ring the bell, and we'll see you this Friday. Should be a very interesting week in the S&P 500 index this week. So we'll see you this Friday on the stock play of the day overtime.